Despite the wide range of geopolitical risks and challenges to the markets around the globe, from North Korea to US trade wars to housing bubble risks here, stock markets are back near record highs overseas and locally near post-GFC highs. Let's explore this anomaly and consider which risks are most relevant here. Since Trump's surprise presidential victory last November, US stocks have powered ahead without regard to geopolitical risks or US debt levels, and seemingly with great confidence that promised tax cuts and infrastructure incentives will lift corporate profits and drive US growth. As the chart shows, we are back flirting with the 21,000 level on the Dow Jones Index. But 100 days on from Trump's inauguration on January 20th, there's been a lot promised, but not a great deal delivered. So the latest run higher in the Dow does seem to assume the long-promised tax cuts will have more success through Congress than repealing Obamacare, building border walls, or enforcing travel bans by executive order. At the same time, there's renewed focus on NAFTA and other free trade agreements. So presumably, the market is also comfortable with the America First foreign policy and its consequences. How this all plays out concurrently with the tensions on the Korean Peninsula, in Syria and in Afghanistan, to name a few, is anyone's guess. But for us here in Australia, while the US is arguably Australia's most important security partner, China is clearly our most important trading partner. And the latest GDP growth read from China was pleasing at 6.9%, albeit with the normal dose of scepticism that this official number completely matches reality. Nevertheless, China's trade volumes and some of its domestic indicators, including electricity output and property construction, are holding up well. This has again flowed through to our terms of trade, with Australian export prices up 9.4% in the March quarter and over 29% year on year, even with the latest pullback in iron ore, back below US $70 per tonne. With the stronger US dollar, the weaker Aussie is also good news. And while we're stuck in a broader 72 to 78 cent band, and more recently in a 74.5 to 77 cent band, the Aussie has a weak tone just for now, and another look at 72 cents may be on the cards. As we've said before, a weaker Aussie can do more for us than an interest rate cut, given its link to tourism and other service exports. So the latest increase in the value of the US dollar does help us here. Official interest rates aren't going anywhere in a hurry for now after the latest inflation data, and with CPI and core underlying measures ticking higher, any further RBA rate cuts look highly unlikely. But equally, rate hikes beyond macroprudential measures also appear well down the track from here. So the luxury our economy has enjoyed of very low interest rates for borrowers, afforded by low inflation and a low growth environment, should persist. But the warnings from APRA, the RBA and ASIC are salient. Should inflation push higher, the RBA will have to lift rates, and in that scenario, highly geared borrowers will be tested. Again, stock markets here imply that risk may be overstated, but it remains a risk nevertheless. So there are risks and challenges from all angles, but for now, the markets are taking them all in their stride. And that's the market update from Bendigo Bank.